It's an age-old question. What's better, growth or dividend/value investing? According to the common knowledge on the internet is when you're young, you should be a growth investor, take on a high level of risk, and then at some point when you're older, transition, maybe all at once, switch from that growth strategy to a more diversified, passive, safe, dividend value income approach. And I'd say my opinion, just generally speaking on the matter, based off of the data I've seen, at least theoretically, that's not a bad way to go. Now, when it comes to my approach here, I am relatively young, in my late 20s, and I am a quote unquote dividend investor right now. And I do get questions all the time as to why I don't just go all in on growth. Why do I have dividend investments at this stage of my life? And my response to that is that the term dividend or growth investor doesn't have one consistent definition. So for example, being a dividend investor doesn't mean that you only buy J&J. Although historically speaking, if you did consistently buy J&J over the long term, you would have greatly outperformed the market and most quote-unquote growth investments. Taking a peek into my portfolio, my approach to dividend investing is very different than I think most people's definition. First thing I want to point out is that a third of my portfolio is dedicated to volatile technology growth stocks. Another third is the S&P 500 broad market index, and then the final third is pure dividends. The most unique thing about this portfolio is that I do incorporate covered call funds, which do limit my upside in exchange for realizing current gains. It's by no means the majority of my portfolio, but it is a component of my strategy. I view it as a hedge against sideways moving markets and just general high levels of volatility, and over the past year, it's done me extremely well. So this portfolio overall gives me a dividend yield of, I think, 4.5%, making it very much so an income portfolio. But the overall growth is still comparable to the rest of the market. It does lag the S&P by a little tiny bit. That's the price I pay for this high level of current consistent cash flow. And to me, as long as that gap is small enough, that trade-off is worth it. So this all goes to show that dividend income investing can be done in many different ways. It's not just one specific technique. And some of them can have very comparable performance to the rest of the market, while others can even have alpha over the market, including over growth stocks. So that's why I believe, personally, if done correctly, a higher yielding portfolio can still have very good growth over the long term. And investing in more volatile assets that are quote unquote growth doesn't necessarily guarantee you're going to have better returns. And I credit this misconception mostly to this chart right here or similar variations. So when you go to Google, you type in a classic growth ETF, you stack it up against a classic dividend ETF, you look over the past 5 years, growth dominates dividends. Now, this is, of course, true. The data isn't fabricated or misleading in any direct way. But with most things in life, you have to look at the bigger picture. Since about 2010, we've been in a very strong bull market that historically isn't the norm. And during this bull market, tech companies in particular have done very well. I mean, just think about Apple from 2010 to right now. Now, of course, I fully expect tech to continue to grow, innovate, and new things to happen. It's just that I think looking at the past decade to project the next decade is not the right analog. As an analog, I've recently learned that in the 1960s, lots of tech companies that focused on anything related to space during the space race really got ahead of itself and blew up in value during that decade. It would have been easy to project that the 1970s would have been a continuation of the 60s, but that was not the case. The space and tech bubble did pop, and it took many years to fully recover. Although, of course, right now, very long term, tech is much higher than it was back then. But it's a cyclical journey from there to where we are now. Okay, so that's big picture stuff. You always want to keep that in the back of your mind and reference it whenever you think things are getting a little bit weird. But even aside from that, on a more individual level, I think we all are familiar with the piece of data that indicates that the average investor severely underperforms the benchmark. So according to this piece of data on 20-year annualized returns by asset class, the average investor only gets an annual return of just over 2%, while the S&P during that time returns about 8.2 per year. And the reason for that has to do in part with the cyclical nature of the stock market that I just talked about. These cycles is why the average investor only returns an average of 2.1% per year. And this chart is a breakdown of the psychology of the market cycle, your emotions that you feel during these times. So even though side by side growth and more volatile assets seem to give you better returns overall, due to us being human and the reality of the stock market, most of us will never realize those enhanced returns or even be able to match the benchmark. So personally, I found that investing in value dividend stocks with less volatility helps me to avoid this negative behavior that leads to underperformance. And also having steady dividends paid to, often on a monthly basis, also helps you to avoid this behavior. After all, if your stock or ETF goes down, say 20%, but you're expecting a large dividend payment in 15 days, you're less likely to sell it, hopefully helping to give you better overall returns. And my final point here is that if you zoom out far enough, and you don't just look at the past 5-year historical return, you zoom out enough that you have more than one cycle on your chart, all of a sudden dividend funds aren't that far behind growth funds. So ticker VIG is a Vanguard Dividend Appreciation ETF, and since May 2006, this has an annual rate of return of 9.02%. In contrast, ticker VUG is a Vanguard Growth ETF. Since the same time, this has an annual return of 10.6. So if you can be fully robotic and dollar cost average over 20 years, never make a mistake during any of these market sell-offs, then yes, you would have been slightly rewarded for it. I'm just of the belief that this chart is easier to hold through, it's less volatile, and we know from the data that your ability to buy and hold over the long term and not sell at inopportune times is the number one determinant of your ultimate returns, and not necessarily picking a line that goes up slightly more than the rest, especially if it's going to be more difficult to hold on to. So coming back to my portfolio, that's why I classify myself as a dividend growth investor. My portfolio has a yield of 4.5%, well above average. It's something I do focus on. There's lots of benefits to this. For example, during the past year when the market was moving down and sideways, that dividend yield was a very nice thing to have. And due to my diversification, I think long-term this portfolio will have excellent returns when compared to the rest of the market. I think the biggest determinant by far in my investing journey over the long term is going to be the human aspect and not making silly mistakes during enthusiastic market cycles. And I think this portfolio is going to help me to avoid that. So let me know your thoughts on growth versus dividend investing. How do you approach the topic? If you enjoyed, I appreciate a like, subscribe, and I'll see you guys in the next one.